Hello students, this is Sonette Smith. This lecture presentation is a continuation of Companies, Lecture 5, and I'm in this presentation going to be focusing on question 8.8, Part D. So this was question 8.8, and you will remember that if you have looked at Lecture 4, that we already did Parts A to C, but now we're going to be doing Part D. What you need to take note of in this question is the redeemable preference share capital, because that's what we're dealing with in Lecture 5. They tell us that Orion Limited on the 28th of February 2003 had preference share capital of 600,000. There are 300,000 no par value preference shares. They also show us an interest expense of 18,000. We need to take note of that because if preference share capital is considered a liability, the dividend is part of interest expense. So this is the required part of question 8.8. We already did parts A to C in lecture 4. If we look now at part D, it requires us to prepare the statement of changes in equity of Orion Limited for the year ended 28th of February 2003. Please note it says if number 7 above. Please change that and put if number 1 above reads as follows. Okay, so there's a mistake. It should be if number 1 above reads as follows. And number 1 above is referring to the additional information given in the question, which we'll look at now. The redeemable preference shares will be redeemed at the option of the company. The dividends are only paid once declared. What this is telling us is that when it's up to the company to pay back or redeem preference shares, it means the company can consider the amount that's been given for the preference shares as part of equity, because it could be that the amount doesn't ever get paid back, at least not in the preference shareholder's lifetime. So in this case, as opposed to what we will see now when we looked at what number 1 looked like previously, we will see in this case the redeemable preference share amount is equity, whereas in the previous number 1 information, the redeemable preference share was indicated as being a liability. So in part C, we already did the statement of changes in equity using the previous information, and in that information we would have been considering preference shares as being a liability. Now in part D, we're going to be considering preference shares as equity. So we're focusing on part D. So this is the additional information that was given in the question. If we look at part 1, it previously had said that the redeemable preference shares will be redeemed on the 28th of February 2008. That means there was a fixed date for redemption, which means the company has to pay back this amount, which then means this is a liability. It also means the fixed annual dividend of 20 cents per share would be considered as being part of interest, and normally with redeemable preference shares they will be cumulative and they will normally always be paid annually per arrangement with the preference shareholders. This information has now been substituted as given in part D of the question, and we now have redeemable preference shares that don't need to be redeemed. It's up to the company whether they want to redeem it or not. And therefore now in part D we're going to be considering the redeemable preference shares as being part of equity. Part 2 of the question doesn't affect us. It's exactly the same as was given, as well as part 3. Part 4 we need to take note of because it says that the dividend preference shares as well as the dividend of 18 cents per ordinary share was declared. That means we now have to take note that this dividend is no longer going to be considered to be interest. This dividend therefore has to be taken out of the expenses, finance expenses, which will have reduced our profits, and it means the dividend is going to be shown as a separate line item on the statement of changes in equity. because the preference shareholders are now equity and not a liability. Part 5, 6 and 7 are the same and won't affect our solution. This is what the statement of changes in equity looked like for Part 88C. I want you just to note that there is no preference share capital here. This was the previous profit for the year, but now I want you to think about it. Previously, the preference share capital was considered to be a liability, so this 129,600 of profit would have had interest that had been deducted on the preference share capital. And that interest is now no longer going to be interest, it's actually going to be a dividend. So then there will need to be a change here in the retained earnings column. The ordinary share capital, revaluation reserve, and asset replacement reserve columns will stay exactly the same. If we now look at the solution for 88D, you will see those three are the same. We're going to find the retained earnings column has changed, and there will also be a column for preference share capital, which, as we said, is now part of equity. So this is the solution for question 88D. So as I said, the ordinary share capital, the revaluation reserve, and the asset replacement reserve haven't changed. Only the preference share capital and the retained earnings amounts are different. Preference share capital is new, it wasn't there previously, and the retained earnings will have to change. You might remember this amount of 172,800 is not the same profit as you saw in the solution for 88C, and we'll look at how we get to this new amount now. So what we can say about solution 88D is that preference share capital has been included because it's now considered to be part of equity, it's not a liability. The balance on the preference share capital, as per the information given us in the question, was 600,000, and there was no change during the year, so the opening and the closing balances are the same. If we now look at the retained earnings column, the opening balance is the same as it was already previously. We're going to look at how the profit for the year has changed, because now we're going to exclude preference share dividends from our profit calculation, because remember, these preference share dividends previously would have considered to be part of interest expense. So if I go back to the statement of profit and loss that we did as per question 88C, what I've done here is I've taken out of the statement of profit and loss the dividend on the preference shares. So in question 88C, there was a dividend on preference shares that had been included in finance costs. You might remember on the trial balance, there was 18,000 Rand of finance costs, and 60,000 was added to that as being the preference dividend on the liability, which was part of interest. Now we're going to subtract that preference dividend amount, which makes our interest lower. Previously, the interest had been 78,000. Now it's only 18,000. Because the interest is lower, our profit is going to be higher. You will notice it's higher by 60,000. 240,000 minus 180 is 60. That means it's because the dividend on the preference shares is no longer shown as an expense. The income tax expense calculation needs to change because we're going to now calculate income tax on 240,000 instead of on 180,000. So the income tax expense amount now becomes 67,200, and the profit for the year now becomes 172,800. So the changes here have arisen solely because the amount for the preference dividend is no longer going to be shown on the statement of profit and loss as part of finance costs. It's going to be shown separately as a dividend. So if you go back to your statement of changes in equity solution, you will now see that this 172,800 is the amount that I've just shown you, the recalculated profit for the year, excluding the dividend on the preference shares. If you now look at the dividend amount in the retained earnings column, so dividends are subtracted from retained earnings. Remember, that's what dividends are. They're an appropriation of the profits that the company has made that get paid out to shareholders. We originally had ordinary dividends of 36,000. That was on our original solution. Now we're adding the 60,000 dividends on preference shares, giving us the total dividend amount of 96,000. So I hope you can see this 60,000 has now been subtracted and is not included in the profit because it was an expense. It means the profit is now higher. But because we've now included it as part of dividends, our dividends on the statement of changes in equity is now a higher amount. Dividends is a deduction from retained earnings. It's an appropriation of profit. So we started off with retained earnings at the beginning of the year. We added the profits for the year, and then we take away the dividends that are paid to ordinary and preference shareholders. And then finally, there was a transfer to the asset replacement reserve that gives us the closing balance on retained earnings of 185,800. So the two major changes to the statement of changes in equity are that we included a preference share capital column because the preference share capital was redeemable at the option of the company, which means it's now part of equity. So on your statement of financial position, you would now have the 425,000 for ordinary share capital and the 600,000 for preference share capital being disclosed. Previously, the 600,000 for preference share capital would have been disclosed as a liability. The other change was that in the retained earnings, our preference share dividend of 60,000 had been taken out of profits, meaning profits went up, and had now been included as part of dividends. So the point of this question was to show you that preference shares can either be a liability or equity. In the first part of question 8.8, preference shares were treated as a liability. In question 8.8 part D, preference shares are being treated as equity.